Anand Tandon is now joining us. Anand, good afternoon. Firstly, wish you a happy 2016. What is your view on the markets? Are you positive?
Well, wish you a happy 2016 as well, and through you, through all your viewers. The market generally is fairly strong right now, except that the index is not likely to be moving, and I don't expect that to change substantially over the first half. More as a hope than strategy, the expectation is that the second half may be a little better. One, because of the base effect, and two, because you may actually find that there is some growth which finally comes through in terms of corporate earnings in the second half. That said, unless there are issues in terms of what we see in the global market vis-a-vis China or liquidity problems, I would imagine that the broader market will continue to offer you decent opportunities to invest.
Right. How would you look at the opportunities into 2016? You think opportunities will be more in the large cap space because the valuations over there are now looking particularly attractive?
Well, I mean, I can't find too many stocks that in the large cap which I would rush out to buy. I think the earnings will continue to drag. The expectation right now, consensus still seems to show a 20% growth, which I think is far too optimistic. I think at the index level, 12 to 15% is more likely, which means that if you assume that we finish this year with a Sensex earnings of 1400 and change, you are trading at close to about 16 times FY17 earnings already. Which is the mid-range at which the market does trade, and therefore I don't see that the front line will give you much upside. Which is why I said you need to have a little more patience, maybe wait for the earnings to start popping up towards the second half of the year, especially when you start to look at FY18 earnings, which is when you might see actually a front line movement in terms of earnings growth and consequently the market. Right.
How would you look at the pharma sector and the problems that we are seeing? We had Cadila Healthcare coming up with some issues today. You think US FDA risk is now increasingly becoming very big for any investor to take any positions into large cap company?
Well, the FDA risk has always been there, except that with the FDA now moving to India, it has obviously become a lot more active. And therefore, the level of inspection and the number of inspections has increased fairly rapidly. And consequently, almost all companies are beginning to see some signs of issues that come up when the inspections happen. I think that needs to be now factored in, especially when you are looking at companies which are trading at 35 times or thereabouts times earnings. You need to factor in the fact that there will be many of these earnings lumps that will happen, these warnings that may come through, and consequently perhaps the valuation need not be as stretched as it is. So while there is some good news in terms of the fact that the pipeline for drugs which are going off patent still remains fairly robust, and therefore the opportunity that Indian companies have is still fairly large, I think the market is perhaps being a little too bullish. So you need to find a little more niche players perhaps which will go through, or you need to find companies which have just come out of the warning and perhaps are resurrecting themselves. So rather than looking at those which are already doing very well, you may want to find those which are a little more special situation.
Right, but can that be something like a Dr. Lal Path Labs, which is a not so FMCG play, not so pharma play, right in between? Can those sort of businesses be looked?
Well, Path Labs have two issues that I don't know how to get my arms around. One, the fact is that the reality is that a lot of the Path Labs have to pay money to the doctors to get referral business. And you may be the most ethical person in the market, but if the rest of the market is behaving like that, it is very difficult for somebody to stand out and grow. So that brings a bit of uncertainty in my mind in terms of the top line. The second thing is, and this is something that the market is not willing to consider at the moment, there is tremendous change and innovation that is happening in the pathological field in terms of testing itself. If you look carefully, you will find that there is, for example, technology which is now making its way in the market where a small drop of blood can perhaps do 40 tests at a fraction of the cost that is being currently done. A lot of things like dialysis and so on, which were perhaps required you to go visit the hospital, are today getting into a situation where it can be mobile. So the changes in the pathological testing, I think, are going to be much more rapid than the market thinks. and therefore that needs to be factored in when you're looking at investments. Again, I think here, because of the kind of scarcity factor, one is tending to be a lot more bullish and ignoring some of the risks.
Right, but again, whenever one is investing into such businesses, valuation should always be taken into consideration, because something like Dr. Lal is trading at more than 50 times trailing EPS.
Well, exactly right. I didn't want to get into the valuations of a particular stock, but the fact of the matter is that if you assume that a company is trading very expensive, you have to assume that there is going to be constant and fairly rapid growth coming for many years in the future. And my only submission is that, as I said, many of the technological innovations that are likely to come through in the next few years will be much more surprising to the market and much more rapid than most people expect. And therefore, that needs to be factored into the prices.
Right. How would you go ahead and approach IT? IT as a pack has not done well. Estimates are not that great, but at the same time, even valuations have been corrected. Do you think that IT can come back to the growth of 15-20% on a year-to-year basis, or is that largely behind?
I think maybe 18% will be too aggressive. 15% maybe touch and go, especially given the fact in rupee terms, because of the fact that I still expect that the rupee will continue to weaken for the next 6 months at least. It is very likely that you may get an upside from the IT, much more than perhaps the analysts are factoring in. The other thing you have to note is that while the frontline IT has done nothing, the mid caps have done quite well. There are many product companies which have done exceedingly well over the last 12 months, and many of the smaller companies are also shaping up in ways which are allowing them to create certain niches and do quite well. So by and large, I think that is less controversial sector. I would imagine that aside from the visa issue, the business growth in the US may actually be more robust than people think, especially in BFSI. And I would argue, therefore, that that is perhaps quite positive for the Indian IT industry.
Right. So any decline in the large cap space would be a buying opportunity, as even mid caps have done well. So valuations over there are also not that attractive.
Well, yes, many of them are not particularly attractively priced, but because the earning opportunity is a little higher in terms of the growth, perhaps that will get normalized a little more. But what I was essentially saying is that I think the front line may actually do well after having a bad year last year. The next year may actually offer more opportunities, because I think the market will be a little more sanguine and may find that it's doing a little better in terms of the demand. The only issue, as I said, is the visa rates, which will take away some of that thing unless they're able to pass it on to their end users.
Right. So how would you look at the digital space? We have had a few IPOs coming now. You think a few digital IPOs that come in, or playing it via the logistics theme, is that something which will still continue? Digital will still continue to grow very fast?
So by digital, I assume you mean e-commerce. For the e-commerce business, the business model to me appears to be very simple. Take equity, convert it into losses, subsidize the consumer. So long as the money is available, yes, the business will continue to grow, because if so long as you are willing to subsidize the consumer, there is no reason on earth why anybody should not be taking up the opportunity. The real question will be what happens when the cash flow becomes a little more strained, and we are beginning to see that in some of the companies, in the restaurant space, in the housing space, and so on, where suddenly with a little bit of requirement that you may actually need to make money, many of these companies are finding that the tap of equity is shutting down. If that were to happen, I think you will find that the fizz moves out very quickly. There will be a few winners, no doubt. There will be few which will continue to have a market space. But I think, it will be a long time before they are able to actually show profits. Remember that Amazon, after so many years and with such a large market space, is still not able to make money in any meaningful way other than a couple of quarters. So I don't think the story will be very different here. Can logistics step in and make the difference? I think, again, here the market is running ahead of itself. For the most part, retail logistics is being set up by the e-commerce companies themselves. Most of them find that either for strategic reasons or because of lack of delivery, they are unable to rely on the existing players. So I don't think that you'll find that the existing players will actually benefit a whole lot from the e-commerce space. Maybe fractionally, yes, but you will find new players coming in. The industrial logistics place, I think, is a far more interesting area. And when and if GST comes through, which I think will be at least 1.5 years away and maybe 3 years before it makes a material difference, there is no doubt that logistic companies will actually benefit quite significantly. But for that, you have to have a time frame of at least 3 to 4 years before you begin to see material impact.
Anand, you think again markets have given aviation the valuation too high or priced it to perfection very fast? The way they are moving, Jet Airways is up 7 today. Interglobe is up 4.5. You think that pricing or essentially the valuations are so high now that returns may be very moderate from here on?
So first of all, let me admit that I don't understand the sector very well. What I do know is that the sector on a consistent basis has not delivered return for any investor ever, not just in India but anywhere globally as well. But the market suddenly seems to have fallen in love with the sector, and clearly there is something which is benefiting them, which is beyond just the fall in oil, because that can't be the only reason for market to be going up, though that is what is being attributed in terms of profitability. To cut a long story short, I think cyclical industries should not be valued at very high valuation, but maybe there is some part of the game which I'm missing, because as I admitted, I don't understand the sector too well.
Right. How would you look at the auto pack with commodity prices coming down now? Probably consumer sentiment should pick up as growth revives. You think autos as a pack would do much better than what they have done earlier?
Broadly, in terms of demand, I think the consumer side of the business will certainly do better. I think, especially once the pay commission and OROP payments start to come into the hands of the people, you would find that the consumption ability goes up, and obviously two-wheelers and four-wheelers are a favorite bet. We've already seen mining activity pick up, and consequently we've seen the commercial vehicle segment start to show some signs of life. The question is, what do you buy? Because you are having companies like Maruti trading at close to 30 times, and so are the truck manufacturers. The two-wheelers haven't shown much sign of life, especially Bajaj, because they don't seem to have scooters, and that seems to have come back to flavor. So among the lot, perhaps TVS is best placed, though this time earnings may be subdued because of what we saw in terms of floods in Chennai. So broadly, though the sector is looking good, and the demand will certainly pick up, I think there's still a challenge trying to find companies to be investing in, and you have to kind of buy stocks with the caveat that the returns may be somewhat muted, or or the fact that there is lack of opportunity in other sectors may propel people to pay a higher premium than you normally would for this sector.
Right. How do you look at media? Media has done well. Zee has done very well. Dish TV, City Cable, all of it is buzzing today. You think media as a sector after 7-8 years of underperformance can do better?
Well, there are two segments to it. One is the content providers like the channels, and the second is the distribution businesses like the Dish TVs and cable companies, as you mentioned. Frankly, I think one has to take a view on what the technology disruption will be. If you think that, for example, 4G will actually do well and will actually bring data to the hands of individuals, then my argument would be that you should be looking at content companies and not so much the distributors, because the distributors will obviously find that they are being bypassed when it comes to the internet. On the other hand, the market seems to be wanting to push both up. So I'm not exactly sure what one is playing for in the market. If you have to look at media, I would think content is the place to be. Now the challenge with content is that there is a huge amount of there's been a huge amount of fragmentation that has happened, because you don't get content only from established channels or newspapers, but also from social media and a whole lot of other websites. So therefore the TRPs etc. per unit actually tend to fall, and that I don't think is likely to change very much. So yes, the media is likely to do better. The earnings, the valuations are already not particularly challenging. I would think look at the content companies, but look at those which have ability to move into the digital space as well.
Right. How would you look at the ADAG pack? Reliance Infra is up 2.5% today. Some of the other ADAG names are doing very well. You think as a group, it will perform well going ahead? Every day you're seeing some buying coming over there.
It does appear that this group has turned the corner. The biggest problem with this group was too many projects, too much leverage, not enough revenue. I think what they have done is now they are looking at moving out of many of the projects, bringing the revenue down, finding partners, and essentially getting into businesses which may actually show them some sustained growth, at least in terms of top line. In particular, I think their identification of defense is something that is fairly strategic, as well as the fact that it is in alignment with what we see the government wanting to do. The amount of market that is available is fairly humongous, because the Indian industry in terms of defense, especially the private sector, is so small that just one segment of that order flow or the offsets is enough to take care of many such companies. Consequently, I think the strategy to my mind appears to be extremely good, and if they are able to actually sell off some of their assets and bring their debt down, I think this will be one of those groups which will resurrect and will reward shareholders fairly significantly. In particular, I think Reliance Infrastructure appears to me to have become the flagship, and certainly whatever announcements one has seen would tend one to believe that, at least at the parent level, that debt can come down fairly significantly. The main issue has been the investments in their cross-group holdings, the ICDs and so on that they pay out. If one can get clarity that that money is coming back, and I hope it will, then certainly the valuation of this company will look very, very unchallenging.
Right, but the point that you made about intergroup money transfer or money given as ICDs, you think as the overall leverage comes down, again the comfort on that money would also come in much better?
Well, that is the expectation and the hope. As I said, there is no doubt there is a lot of movement of money, and some of it may have to be written off as well. But if you look at, for example, what is happening with Reliance Capital, in all the operating businesses other than the NBFC, they have found joint venture partners, and therefore I would imagine that will ring fence some of the businesses as it is. The NBFC is the only part which is a bit of a question mark in terms of what the asset book looks like. Similarly, in Reliance Infrastructure, so hopefully if they actually manage to pay back some of the debt that we are seeing back to some of the companies that they've borrowed from, and then Reliance Infrastructure may tend to get back some of the ICDs as well. As I said, you should expect to see some write-offs, but hopefully the valuations that they will get for their operating businesses will also improve, because the market for financial services, for example, is improving, the market for power sector is improving, for infrastructure generally seems to be doing much better, and so on. And more importantly, especially in the case of infrastructure, much of their investments have actually started to now get to a stage where they are in execution mode. So the capex cycle is over and the operating cycle is now beginning to come through. So things seem to be falling in place for the group as a whole.
Right. How would you look at some of the other names like GMR, GVK from the infrastructure pack, where also there have been debt issues? You think those would take some time before we see any major uptick coming in?
There I don't see much upside even now, because whatever sales have happened, for example in Jaiprakash or JVK and so on, the debt level doesn't seem to have significantly changed dramatically. In fact, because of the compounding interest, that still seems to be a problem. We have to see the banks take a big hit, and that will mean that at least some of the frontline banks will have to recognize these as NPAs and take a write down, which will then allow some of these infrastructure companies to revive their balance sheets. Alternately, they have to bring in a lot more equity, and the question is that right now it appears to me that the value of equity even today is not particularly high, if at all. So if you were to do an equity valuation, you will probably find that some of these may actually be negative. And I don't see how that's going to change very rapidly, because most of the asset-based companies are not going to make a lot of money even if they were to sell the assets, because the asset prices are fairly inflated and are not likely to make any kind of serious returns. So I think my view generally on asset owning companies is stay away from them. But in the names you mentioned particularly, I don't see that much has been done so far which merits a serious look. Much more capital needs to be infused, or much bigger haircuts need to be taken by the lending agencies before these companies can recover.
Right. What is the sort of view as far as some of the defense railway names are concerned, or maybe even the road names, the individual plays over there? Because those are sectors where a lot has been done, a lot has been awarded. You think those are the sectors to watch out for?
Well, certainly, as you said, the road order book seems to be much better. And we have already seen that getting reflected in the stock prices of the construction companies. I would imagine that the road order book will continue to remain fairly robust, because whatever pronouncements we've seen the government come up with, have been fairly aggressive, and so far they are actually upping the ante quite a bit in terms of reducing the time to order as well as making the orders viable by making sure that the orders are placed out only when land acquisition issues are over by and large, and most of the concessions are at a time when they can actually start the work rather than wait for preparatory work to happen. That reduces the risk remarkably, as well as reduces the capital investments required. Consequently, construction companies, I think especially in the road sector, will continue to do well. The only caveat is that you have to remember that this is not a very high yield business, and consequently valuations should not be overstretched. So as an investor, you have to be careful about how much you're getting in and not just look at the top line, but also the bottom line. But aside from there, at least the business flow is there. Railways, the order book has just about started to build up. We've seen about $10 billion worth of, or maybe $8 billion worth of orders being placed a month back or so, and being tendered out. So therefore that has started to move as well. Unfortunately, much of that is not going to come to Indian companies and is going to come from overseas. Some of the overflow will probably come to India. So the immediate benefit in terms of the stock market is a lot less visible. In terms of pure economy and the underlying demand flow, obviously things will improve. So there are fewer companies that you can play in terms of railways, but roads, railways and defense in that order are where you are likely to see the order flows. Defense is by far the largest, but will be back-ended. I think it will take at least 3 years for it to make a material impact. Railways should happen next year. Roads are already in process.
Right, Anand, thank you so much for taking out time for us. Always a pleasure talking to you.